Hey, it's Soleil, and this is episode 418 of the Orange Pill Investor. In order to try to avoid a copyright strike today, I went ahead and uh, that was a cover. That was my son leading off IC HSA acapella finals like 6 years ago. So be nice in the comments. Don't fuck around and get banned. What's up, Nick? What's up, Howard? What's up, Russ? So I am down this rabbit hole with the covered call ETFs. I'm just going to start with IMST. The fund is much smaller. The positions are more straightforward. And then once we get into MSTY, it's really going to get freaky. I had a hell of a time trying to trying to figure this out. So this was 6.9. This is what I covered yesterday. And they had 1,693 longs. They had 13 and 11 shorts, which meant that 382 of their synthetics were uncovered. I added a couple more metrics here too, just to try to gauge overall overall expected returns. And Jay and Jeff, if you guys are listening, you got to start putting some of these metrics on the website. If you go to Strategy's website, they got KPIs, they got all kind of bullshit. And it's 2025, and all of the investors want this stuff done, right? I shouldn't have to be downloading the positions and trying to figure all of this shit out. I guess it's for, makes good content or whatever, but 22% of the synthetics were uncovered. And so I added this too. I went ahead and just tabulated all of the premiums that can be collected over the next week or two, and then divided that by the net asset that they have. This is going to give you a reasonable expectation of how much premium, return on capital, not the return of capital, which is the controversial criticism of some of these covered call ETFs, but how much profit you can expect to collect based on their overall portfolio. And this is pretty reasonable. So 1.8%, and that's within, let's see, half of the positions expire this Friday and half next Friday. So about half of this 1.8%, so about 0.9, almost a percent, is being is profit that they're collecting per week, and then there's an extra 1% almost that's being collected in 2 weeks. So this is like 1.5% a week returns, this particular snapshot. And I think that's a pretty good, this is IMST, by the way. And so I think that's pretty good. I don't find that to be unreasonable. Fast forwarding to this week, they had 1693 synthetics last week. They've added a bunch, but they only have 13 and 11 short positions, the same amount that they had last week. So they added synthetic longs. They didn't take off any of their short positions. You can see I do a VLOOKUP from last week's share count. So they added 133 calls, and they shorted 133 puts. So they added some new synthetic positions, but they didn't add any more short positions, so they just must be expecting some good things to happen. Now, I don't even do TA. I can't imagine what they're looking at that they would think something's going to happen. As an option seller and a Tasty Trade uh, disciple, the number one kind of rule is that you can make a directional bet but for the most part, you're just kind of ambiguous. You hope that you're not investing in a complete dog, right? You don't want your stock to go bankrupt, but to a certain extent, all you care about is the premium. And when implied vol is high, you can be as aggressive as you want to be with the premium. In a low IV environment like this, maybe it makes sense to be less aggressive. But and there's 100 different ways that you can do this, but apparently they're just taking a net long position. You might as well just say that they went out and bought 51,500 shares of Strategy and left them uncovered. That's about 28% of their contracts, potential contracts. And if I run the same, I add up all of the shorts, the short premiums, and then I divide that by their assets under management this week, they're only collecting about 1.3%. So they've used some of those premiums that they collected over the last, couple of weeks or whatever, and have gone just long with it. I don't hate it. And this is finally, and I've only been covering them in depth for just a couple of days, but I was initially caught off guard because IMST was supposed to have this, they wanted to capture more of the upside. And I wasn't seeing it, but I am seeing it now. So I guess that's good. They're distinguishing themselves a little bit from pure covered call ETF plays. But you can look at their expiration dates. Some of them are for this week, some of them are for next week. So really, the guaranteed profits that we're collecting here in IMST now have dropped. It looks like it's only dropped by 0.5%, but you got to keep in mind that only half of this is going to be captured by this Friday. So that's about 6.67 tenths of a percent will be captured by this Friday. And then the other 0.6% will be captured for the next week. So our weekly premiums has been dropped considerably. If Strategy is still trading at 385 to 400 over the next month, I would think they would have a difficult time paying out some juicy dividends. However, the net longs that they took, it doesn't really matter. You can say that all of these shorts are being sold against the 365s, the 370s, the 390s. I don't know if that's really a distinction without a difference or not, but the point is that if Strategy's price doesn't move, then these synthetic longs will also not move. So my assumption would be is they're hoping that the price will go up to 415, 425, something like that, and then they would be able to close some of those long positions or leave them in place and capture more premium at a higher base price. So one way or another, if the price goes up, they should be able to jumpstart this return on capital. But if strategies just trade sideways for the next month, then all of these uncovered positions basically do nothing, right? It's just like holding spot. So I guess I'm I'm ambivalent about this. I like the aggressive 390s and the 385s for the week. You can see that this is the single largest position and source of premium that they're capturing. Um, and so the ones that they're capturing for next week, it's much less, but it's not necessarily, you gotta look at the strikes too. So the premium for going 2 weeks out has diminishing returns, and they're selling at a higher strike, which kinda makes sense. The longer the days to expiration, the more likely that something will happen with the price. So, going out to 410 and 405, 2 weeks out, there's nothing wrong with that at all. I think that's all I wanted to talk about with IMST, but I'm gonna go ahead and check the chats and see if there's any comments or questions on this section. Howard says, "I know it's more work, but maybe divide the premiums and calculation of return by expiration." Yeah, exactly. I thought about that as well, and I'm like, that's just like more lines and cells and calculations and stuff like that. Um, but 7 to 14 days is still so short term, and the gamma risk is still so high. I think it's pretty easy to just eyeball it as well, but I do get your point. I was thinking along the same lines. Thanks for that, Howard. All right, let's move on to and then the other thing, like this isn't even a download. Like I had to copy and paste from the website. Um, so that's kind of funny. All right, so this is the 610 download for MSTY, and I've added some orange here just to call out something that I missed last time. And then I've got a bunch more orange things to talk about this week. But let's just go back and see what I missed last week. So I didn't notice that this synthetic that they created, and maybe I just caught them in the middle of rolling. Maybe these are like up to date or something, and I downloaded this in the middle of a roll. But usually a synthetic is the exact same expiration date and the exact same strike. And so I matched up these 9,000 puts with these 9,000 calls, 380 put, 380 call. However, I didn't notice that the puts that they sold were for 718 and the puts, excuse me, and the calls that they bought were for 725. This isn't like the end of the world, it's just a week off, but this isn't truly a synthetic now at this point. So the 380 for a week later is going to have a slightly higher delta. So this is like, I don't know, instead of being 100 delta, maybe it's 101 or 102 or 105 or something. But some of these things will come into play next week. And so just taking a look here, I already had the net longs 1150, and I had mistakenly said that this was like 7 or 8%, but that is not the case. I was thinking that this is 1% or 10% of this, but that would be 12,000. So this is only 1%. They only took a 1% net long position. So not a lot, really. Which is fine because that, you know, prior to this, they were a pure premium play. And so just taking like a 1% uncovered net long position is fine. It's just taking a little stab at it. Whereas at least today, IMST is taking a significant long position. They're making they're making a very large long bet. And it really doesn't matter that these expire on the 20th, because since it just represents the spot shares, they can just continue to roll their synthetics out to July, August, September, every 2 to 4 weeks, whatever. Doesn't really matter. They can continue to do that and not really gain or lose much of anything, and kind of wait for the next face melting rally. So it does look like MST is taking a much smaller long position as of last week. And we'll get into what they have done just in the last, I guess, 24 hours. They're collecting, they've got like almost a $5 billion fund. So their short premium is much higher, of course, in raw numbers, but then even as the return of capital and the basically the guaranteed returns is also much higher. And not only is it much higher, but they're all expiring this Friday. So there's a ton of premium being just they're squeezing a ton of juice out of this damn thing, which I like to see, really, for a covered call ETF that's generating dividends from premium. So this is juiced way up compared to IMST, but IMST will benefit from a rally if it hits. This is as of yesterday. As of today, we got some things to talk about. So I did a VLOOKUP against last week's positions, and I noticed something a little strange here. So this position was here. These 400 calls for this Friday. These were here last week, but these were shorts. Let's just take a look. The 613, 400 calls. They had 6,000 short positions. They not only covered all 6,000 of those positions, but they went ahead and bought 17,500 long calls for this Friday. Now that freaked me out a little bit until I found this line item right below it. They went ahead and sold a bunch of the 410s. The 400s are a little bit more expensive than the 410s, which means that these 17,500 of these, you can basically just call this a call debit spread. So if the price runs over 410, they would capture the $10 per contract here. 410, 400 is a 10 point wide spread. But this doesn't make any sense to me. So while last week I was stoked, I'm like, oh, okay, they're being really aggressive, collecting all this premium. But now it looks like they're making like some YOLO DGen 7 DTE. You got to look at the date too here, though. So they're long this Friday with the 400. So this isn't even a call debit spread. This would be, I guess, some kind of calendar diagonal or spread or something. The only other weird thing that they did is there's 9,000 new 380s for 718, but that's just them rolling. So maybe I caught them in the middle of a roll. They had the 725s, which was the inconsistency that I saw here, right? They sold the 718 puts, and they bought the 725 calls, but then they rectified that. So maybe I just caught them in the middle of a roll or something. But I don't know why that you would roll your synthetics from a longer expiration to a shorter one. It makes sense to me that once they get close to expiration, you would roll from a shorter one to a longer one. So even though I understand that this may have been a roll, it seems like it's rolling in the wrong direction. So this is a little bit of a head scratcher for me too. But this made my my little metrics that I was starting to track harder to figure out, because now I don't just have. So I kind of freaked out a little bit. I was like, okay, I got 122,715 synthetics, and I was like, okay, let me see how many shorts I got. And the shorts were more than the longs, and I was like, holy shit, are they selling naked calls? And I had to go to Grok and ask if covered call ETFs are allowed to even sell naked calls. Probably not. I don't think it's necessarily like illegal or anything, but they're, the banking institutions or whoever is giving them margin or capital swaps, or I don't even however that shit works, they would probably be like, nah, you're not selling naked. So anyway, I had to do the little bit of extra digging and do the research, and no, they are not selling nakeds. They went ahead and bought a bunch of these long calls, and so now they don't. I had to figure out how how long they are, but these are net long calls. They're not synthetics. So these would definitely benefit more from a nice rally up, but they're so short term. I don't want to own these damn things. If we finish out the week under 400, these are all losers. These are 100% losses here. Now, the calls that they sold to kind of compensate for this might print, but they're a farther week out. So we're going to take the losses on the 400 longs this Friday. And it's going to take us another week to like capture that on the back end. So this is confusing to me. And I could just chalk it up to, they know some secret mojo that I'm not privy to, and maybe all of this hocus pocus is worth the 1% management fee that we're paying them. But I don't like it. Like, if they wanted to buy, what is this, June? If they wanted to buy to the December or January 400s, or even go 10-20% out of the money and get the 500 strikes, that would be like, I'm down with that, because I don't know what the hell's going to happen next week. But in the next 6 months, like, if we don't get some kind of Bitcoin action, that's going to be there's going to be a lot of 4-year cycle Bitcoin maxis scratching their heads if we don't, it's like the bull market is over. But what's going to happen next week, I don't have the slightest freaking idea. So I don't like taking these directional bets on such a short time frame. And not only that, it's just canceling out the premiums that you're collecting. So we're slamming and jamming and collecting a ton of premium here, and then we're just gonna like piss it all away by buying a bunch of calls that expire on the same day. Like, theta is almost identical for these positions. The same amount of money that's draining into our account on these 397.50s is like barely more than these 400s, and less than these 410s. So I thought I was smelling what they were stepping in, but now I need an explanation. And then that makes my little extra metrics that I started to calculate kind of meaningless and even harder to figure out because, even like Howard's suggestion, oh, okay, maybe I can break it up and see. And actually, all of these are this Friday. So, yeah, we're not. Oh, no, I'm sorry. These are next. Actually, these are 2 weeks from now or 12 days. So, yeah, it's not even the 20th. It's not even the Friday after the 13th. It's 6/25, which is an extra 5 days, not 7. So yeah, I'd have to prorate out this premium for a partial, not even like this week or next week, but now it's like a partial week and that's just too much bullshit. Let me log in. This should be easy to do. I mean, and I think Jay used to work with the Tastytrade people back when they were, was it Thinkorswim or TD something? I think he was affiliated with some people. If I could have that wrong. I saw him mentioning some of that stuff in his in an interview. But this right here, net theta. There's no reason why, if Tastytrade can calculate this and put this on my personal dashboard, there's no reason why I should be fucking around with Excel spreadsheets. Like the net theta should be there. The theta per assets under management should be there. I think Tastytrade, I heard Tom mention a goal for net theta per net lick would be like, I think 1/3 to 0.5% per day. Something along those lines. But yeah, just, I think the next covered call ETF that distinguishes themselves by putting together, something that's a cross between this TradFi stuff and what Strategy's doing with their dashboards and KPIs and all of that stuff. If you can package these metrics together, like the sophisticated retail investors are just going to eat this shit up. So anyway, getting back to this frickin' thing. So they closed their 6,000 shorts. They added 17,500 long positions. Then they sold 25,500 shorts 2 weeks out. And then they rolled their 725 calls like to expire a week earlier for some frickin' reason. I guess they'd be a week cheaper, right? If they're that close, a little bit closer to expiration, the call would be cheaper, but then you wouldn't capture as much premium. So yeah, I don't know. It still doesn't make any sense to me. All right, so their net longs now are 1150, but these are not synthetics. These are like straight up long calls. But anyway, so their return on capital is still pretty juicy. It's 2% basically, and it was 2.4% last week. And really, that's literally almost all of that is for a week. I guess these 25,000 is actually 2 weeks, 14 days. So you'd have to like prorate half of this out. So yeah, maybe this is like, I don't know, somewhere between 1.5% and per week. And it was 2.4. So by adding these debit spreads, they have eaten into their premium capture and gone like degen wild with these long calls, and I don't just dislike it, I kind of hate it. I don't like it. I mean, I don't like anything I don't understand, number one. But I screwed up the format on the date. But I think I'm not going to go so far as to say that it's not transparent and like it's intentionally hiding from the investors what they're doing. But I think it's very hard for the investor to understand the risks that they're taking with this fund. And I know they changed their prospectus or whatever, right? That they're going to start taking these long positions. But I would much rather sit in a synthetic long position that IMST is taking, because they can just roll this out forever. It's basically like holding spot. Whereas these debit spreads are so close to expiration that if we don't get movement in the stock, then this is just lighting money on fire, in my opinion. And to a certain extent, you can justify it because you're saying, okay, well, I'm gonna pay for these longs by selling the shorts. But the point is selling the shorts. The point isn't selling the shorts to go long. But the funny part about it is that's the method that I've been using to out trade them. I finally pulled ahead like $8,000 total. So the covered call ETFs are finally turning a profit after the last couple of dividends. They're up to, I believe, 222,000, and I started with approximately 216,000. So they're up $6,000 since January. So maybe $1,000 a month on a $100,000 over $200,000 investment. And currently I'm sitting around 230, I believe. So my gains are about double theirs. Now, of course, they were wiping the floor with me for like 4 months straight because I was taking some of those riskier long positions. But even the ones that I was taking, let's just go to that account. The positions that I was taking, and even my June, so in January, I was buying Junes and Julys, and those had 90% losses. So I gave myself 5-6 months to be right, and I was still wrong. They're betting on next Friday. That's wild to me. So I'm selling short 30, 45 days out, and I'm buying 6 months out. These Septembers I've had for 89 days. So I bought these when they were 189 days to expiration. Like MSTY might be I don't know if they're going to change their name to like irresponsibly long covered call strategies. Like, actually, it's not even a covered call strategy at that point. $6,343,750 of long call exposure to the 400 strike by this Friday. Now it's offset by the ones for 2 weeks from now, but what good is this going to do us in the next 4 days? 2 days. I don't like it. It could work out. I mean, I hope it does work out. It'll pump my bags because I've got in my IRA, I've got 5,316 of their shares. So I hope it works out for my sake. All right, let's check the chats. I can't imagine there's any trades that I'm going to make today because strategy is really not doing much of anything. If the price was dropping, then I would need to roll some stuff. Tesla's doing good things, so that's cool. Back in profits there, so liking that. But let's check the chats and then keep it moving. Dude Face, I bet you could get an interview with the fund manager at YieldMax. Perhaps it would be an interesting conversation. It could be useful. Yeah, I was thinking about that as well. He does seem to be friendly with some of the covered call selling channels that I've seen covering his work. So yeah, I wouldn't mind having him, Jay, and even Jeff from IMST on, but I'd probably have to reel in my 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 attitude. That date format is bad, missing the day. Is that what are we talking about the I don't know. Dude Face, looking at the chain, the weeklies though have a higher IV, so would the percentage of the premium be higher potential? That would explain why they do it. Looking at the chain, the weeklies have a higher IV, so would the percentage of the premium be a higher potential? I don't remember what I was talking about when you typed that comment. 625 is June 2025 a typo in the data? I don't know. What's up, Rob? Dang, MSTY always hanging up our upside moves. Let's see, Doofus. I wonder if the growth in their fund had caused them to try to outthink the market makers. There's always someone on the other side of the trade. Yeah, they might be. So when I lost a shitload of money with Poorman's covered calls on Tesla when it went from 400 a share down to 100 after the Fed raised interest rates, the guy who got me into options, when I told him how much money I had lost, he's like, "That's like impossible." Um, and I was like, "No, I wasn't just selling regular covered calls. I was selling Poorman's covered calls." And he's like, "Okay, well, that's what you get for eggheading it." So I'm wondering if they're just eggheading this shit a little too much. Who knows? Howard, sorry for the stupid question, but could the date be a typo on that spread? Oh, possible. So that's what you guys are talking about? Maybe this really isn't the Oh, I see what you're saying. Okay, gotcha. So that's what J29 was also talking about. So this could be June of 2025 and the date is missing. Well, let's look at it. Yeah, good call out, because if you look at the QSIP, it's 2025 June 13th. Thanks, guys. So it's not a typo, it's operator error. So that's on me. So this isn't 6. This isn't June 25th. This is June of 2025 on the 13th. Okay. So now it's at least not a calendar spread. And we know that these expire on the same day. But let's analyze that, because if it doesn't get over 610, well, if it doesn't get over 600, we lose 100% of that money. And we needed to get over 610 to capture all of it. So if we want, the prices are going to be a little bit different, but the principle's still the same. We're going to buy the 400s and sell the 410s. This should be a put. I'm sorry, a a debit call spread. And this, no, got the, not the 4250, the 10. So it was probably a little bit more expensive when they bought it. Let's check the graph. So above, the break-even price is going to be like what, 401.26, basically the cost of the option. And we got to get above that to start making any money. But if we're under 401.26, we lose, well, the most we can lose is the 126 that we paid. So there is a potential for a large outsized return here, right? A max win, if we end the week over 410, is $874 on a $124 bet. So is that an 8x, 7x? So we have the potential to 7x, but we needed to move. We needed to finish the week above 410. So I still hate it. I'm not a fan of trying to predict what the price will be in 3 days. See, Joshy T, I still don't get why people wouldn't spend the time doing covered calls themselves and get MSTY instead. After your clear explanation so many times on their poor execution, I guess it's their own money and wouldn't mind losing it after all. Yeah. The one use case I can see is, I mean, some people are just busy, right? Like when I had to work 40 hours a week, probably more, like figuring out some time to learn this shit was kind of rough. But yeah, it's really not rocket surgery. But anyway, once you get to a certain portfolio size, right? Once you attain a certain level of wealth, every single thing that you should be doing in your life is paying other people to do things that you don't want to do. Because every time you do that, it's an extra hour, it's an extra day of time that you get to do things you want to do. When you're broke, I spent 99.9% of my life paycheck to paycheck. You have to mow the grass if you don't like it. I mean, I know somebody who loves to mow the grass. He just grabs a cold beer, fucking puts his headphones in, gets on the riding lawnmower, and he's got a bunch of yard, and he spends an hour on the riding lawnmower, and he just gets to get away from everybody and decompress. Like, he loves that shit. Okay, well, don't pay anybody to mow your lawn for you. I friggin' hate it. So I might have to get a lawn service, because that's just an extra hour of week that I can put back in my pocket, and the money kind of becomes meaningless, and it's like just enjoyment, or not necessarily like pleasure, right? Because you can you can do certain things that are pleasurable, and then as soon as you stop doing them, you're not feeling that pleasure anymore. Um, but just being able to have more time to do whatever the hell you want to do with it makes the most sense to me. And so in that case, if it's just super easy for someone to go to their portfolio and be like, you know what, I want to quit my job, but I don't want to deal with it. I'm going to put 80% of my portfolio in stocks, and I can put the other 20% into covered call ETFs and let that, and then that's my budget, right? Whatever the dividends are that month, that's my budget. That's my spending money. If that gives them more free time to frickin' walk the dogs and go to the movies and surf and do whatever the hell things people like to do, then that's probably the right thing. But I do agree with you on the sentiment. Like but for me, I'm a gamer. I like trying to get high score. I like PvP. I like competition. So this is kind of like, it's kind of fun for me. So I don't mind doing it. Anybody who, if this was like a chore, this was like pulling teeth, then by all means, pay somebody else. Russ, if they're gonna play short and hold longs, why why not take my money and go long and live on margin until take profit? Oh God. All right, so they also have access to a Bloomberg terminal, and so does Jeff Park. They can see the chain in a completely different way than we do. They might see an ARB we don't even notice. Yeah, all of that's possible, but a bunch of other people have Bloomberg terminals too, and they're all on the other side of those trades. And I think there's some basic principles that you can't get around. The price of the option is the only thing that matters. Just like the price of the stock to a certain extent is the only thing that matters. That has to go up. If, if IV right now is low, but selling a covered call for this week is still 1.5%, 1.25 return on capital in half a week, that's still miles above any of the other low IV TradFi stocks. And there's nothing that they can see in the Bloomberg terminal that's going to alter the fact that options under 60 days have increasing theta. And the rate of increase of the increase is increasing. The one thing that Tom Sosnoff likes to say is whenever somebody comes to him and is long something or short something, he'll just take the opposite trade because most people are just wrong all the fucking time. So for the most part, anybody who's bullish on something, you can probably short it and be right. And so that's why I try not to make important directional bets with a short time frame. I know Bitcoin is going up. Might not be this year, might not be next year, but nobody's ever lost money in Bitcoin if they held for 5 years. So that's my standard that I'm taking with me into the future. So I think the same thing would be true with strategy if they continue to be, to execute attacking, the bond market and stacking sats. I think that same thing should be true. Holding for 5 years is as close to a guaranteed profit as can be found. But I can't imagine there's anything in the Bloomberg terminal that is going to make theta somehow go slower by this Friday. They might have some TA magic, but I don't know. I do have to admit that this low IV environment is the best time to be buying these things. So at least they're paying dirt cheap prices for them. If I have to throw them a bone, if I have to steel man the case for what they're doing and pretend that I don't not hate it, or pretend that I don't hate it, at least with these low IV prices, buying these debit spreads this is like the cheapest you're going to be able to do this. So if you're going to YOLO, you might as well buy the cheapest YOLOs available. So I will give them that. If you're going to do it, I think the time to do it is now. What's up, Mark? Just got approved for options on my account. Congratulations. Baby steps. No YOLOs. Not financial advice, but see, Chashi, 4.7 billion assets under management for Misty. I guess we're not the norm. Just like how Bitcoiners are not the norm and so early to capture the wealth transfer. Yeah, that brings up the other thing too. If you've only got 100 shares and they get called away, you're kind of bumfuggled, and now you can't get in anymore. If MSTY has 10,000 contracts called away because they shorted at 400 and it went to 425, yeah, they've still got 4.5 billion dollars worth of assets left, and they can just roll it. It's just kind of meaningless for a fund that size. So that's the other thing, is sometimes people, when they sell covered calls, they get that anxiety that their strikes are being breached, and they're worried that their shares are going to get called away. And when you buy these covered call ETFs, like, that's their problem. You're paying them to have to watch and sweat the rallies. Let's see. I'll say we understand options writing here, but there is large majority that doesn't. They barely understand the very basics of the market. We are a minority. It's a 1% of a 1% of a 1%. Yeah, you're probably right. Rob, 100% agree. If there's a time to debit spread, now's the time. Yeah. And as I was saying that, I was like, damn, maybe I should do it. But even if I was going to do it, I would do like I did the other ones. Where's my account? I would still probably go out. I'm still not doing that YOLO shit. So I would probably still go out here and do, like, I don't really have much money. Matter of fact, I'm on margin. But let's just see if I can find something. Like, if I wanted to capture a bunch of the gamma curve, let's go out 20% out of the money. What was that, like 460? We can go to the 500. Let's see, buy the 500 strikes and sell the 510. It's going to cost me double what they're paying, right? But I've got 6 months to be right. I mean, technically 3 months, because I would sell these at 90 days anyway. But let's see, 10 of them would cost me $2,000. Might as well just do 20. Let's see if I could see. The only thing that I don't like about strategy spreads is, so the bid ask spread on these is $1 wide on a dollar contract. So it's just annoying. I'm not even doing this. I can't bring myself to have to deal with that shit liquidity. But I do like the idea of doing it. But like the liquidity on a Tesla is just so much better. Like, let's just go out to the same, was it the Decembers? 20% of the money. Let's go somewhere around the 400, 410. So again, a very similar price, $2.45, but the bid ask spread is only 40 cents wide. It's so much easier to get a fill getting into this. And then if I want to exit for a profit, I have to deal with the bid ask spread again. It's much easier to get in and out of a trade like this. So for all the talk of strategy having the most options, market, and all that stuff, it still hasn't translated to a tight bid ask spread. It's pretty bad. So I started getting kind of excited. I'm like, oh yeah, this is the perfect time to do it. But then when when it comes down to it, it's like I can't bring myself to deal with those. A dollar wide bid ask spread on a contract that costs $2. Like, it's 50% of the entire cost of the spread is the bid ask. So I can't bring myself to do it. Let's see, Dude Face. Jordan Peterson interview with Michael Saylor is doing well. It's always interesting to hear him talk to a non-financial, non-Bitcoin person. Yeah, and it seemed like Michael was a little jazzed to be talking to someone intelligent. Every time he gets interviewed on CNBC, he has to, I know he sighs all the time, even when he's like talking to people he likes. But whenever I see him sighing, answering the same frickin' quantum computing question, and it's just he has to answer the same dumbass question from these TradFi people, and then for Peterson to be like, it wasn't like psychoanalyzing him strictly, but you could tell he was interested. He was like, "Oh wow, that's interesting. Like, why did?" It was almost like he had Michael on the couch, like, "So why do you think that you have this drive to be the top of the world?" And, "Oh, your mother, okay, she was very supportive, okay, and your dad was a motivating factor." It was like, okay, did Michael have to like did Jordan invoice him after the freaking interview for counseling services? But yeah, it was pretty cool because Jordan Peterson thinks at a high level, and to see Michael actually like let Jordan finish one of his long ass rambling rants before he gets to jump back in again was kind of cool too. All right, we're all caught up on the chats. I want to say I hope that this was illuminating, but it might have been just as confusing for y'all as it was for me. Appreciate you guys spotting this little this oversight here. This was not June 25th. This was June 13th. That is a critical piece of information. So I'm gonna have to make a I'm gonna have to remember in the future to look at the QSIP, which is gonna have the full not Julian date, the full calendar date in here. I guess we can't trust the security names, unfortunately. I am not I am not going to continue to do all of this shit every day. I think I've kind of got an idea for what they're doing and how they're doing it. If we start to get that move, if Bitcoin starts to make 100K the floor instead of the ceiling, and we start entering into price discovery, and strategy continues to add leverage with the preferreds, and they start getting towards the top of their leverage range instead of the bottom where they are now, I can see IV expanding and I can see some serious shit happening. I'm not saying I like the fucking 7 DTE YOLOs. Um, but I think there's hope. I think there's hope for my September 1080s, my January 890s, and certainly my December 530s. They're not locks, but there's some hope. Actually, there's not a lot of hope left for my Septembers because I'm only going to hold these for another 10 days. So if nothing like amazing happens, I'll take my $2,000 and I'll just buy. Don't I have some December 10/8? Yeah, I'll just buy a couple of Decembers. Right? I'm not gonna hold these Septembers. Now these could hit. Right? I could just hold on to these, and there's going to be a lot more gamma in these Septembers than in the Decembers. So if we did get a sharp move to 750, 800 in the next 2 to 4 weeks, these would print more than these. But it's just not worth it to me to hold them short term. I guess I'm not as irresponsibly long as I thought. Oh, I was about to shut it down, but I need to see if there's anything I need to do. So we're at 387. Yeah, the price is just kind of hanging around. Oh, I meant to put some money in this account. I think I forgot. Yeah. I need to deposit my allowance in here. But let's take a look at the 5K account. My GameStop is holding strong. I kind of placed this trade. The funny thing is, so I placed this trade before earnings, not even realizing it, and then the chat warned me. So the price has dropped, but it's not dropped like precipitously or anything. But the funny thing is, because IV has collapsed, I can still close this for a profit. So IV's down to 13 now. And maybe I should. So the price was $30 a share when I sold this put for $1.50. I can buy it back for $1.12 and pocket the whatever, $37. And that would be about a 1% return in just a couple of days, which is kind of cool. But I may just go ahead and let this assign at $29.50, and then I'll turn around and well, let's just see. If I was going to sell an at the money cash secured put for next week, it's 84. So the premiums have dried up quite a bit because I remember I got like 5% right before earnings because so that must have been the anticipation of earnings. And so for just this week, this is Wednesday, right? Yeah. So, if I was just going to sell the 28.50 for this week, that's a little, almost 2%, but not quite. So we'll call it 1.5% for half a week. So 3% return on capital prorated out for a full week. It's pretty good. It's probably the same return on capital as strategy is paying out right now. Yeah, so I don't hate it. So maybe I'll just let this assign. Is it in this account? Oh, I bought a. Did I buy a GameStop call too? Did I YOLO? I did. That's funny. I forgot I did this. So I must have used the premiums I collected on selling the put to buy the GameStop call. Unless I've had that in there longer and just forgot about it. So I could close this for a small profit, even though the price went against me. And that's kind of the beauty of earnings plays. Selling premium right before earnings, and then you get Ivy Crush, you buy it back cheaper, even when the price goes against you, right? This put should be more expensive now than when I sold it because the price went down. This is actually freaking in the money now. But I can sell it, or excuse me, I can buy it back for cheaper than I sold it for if I wanted to. But let's look and see what GameStop's price has been fluctuating at. So this is probably when they started hinting about buying Bitcoin and taking pictures with Michael Saylor and all kinds of shit. And so, like, worst case scenario, it goes back to where it was at the bottom, $20 a share. I can still make money selling premium on that. So maybe I'll what did it top out at? 35? This will be fine. I'll just let this assign, and then Monday morning I'll turn around and sell a covered call against it. We'll just turn it into a wheel. Maybe it'll be a little bit more fun to have something that's not a mining stock in this portfolio. It costs about the same as 300 shares of a miner too, so it's like one less position for me to have to deal with. So that's kind of cool too. Let's see, this 9.5 put. I wonder if I should roll this. Sold it for 24. There's only $3 left. There's no reason for me to hold this. I've already collected 87% of the return in half a week. I'm not going to hold it for the other 50% of the time to collect 13% of the money. So let's buy to close. And do I have any buying power? I mean, of course, I've got the $950 of released collateral, but if I want to roll this to the $10 strike for more premium, yeah, I've got $1,200. Just want to make sure I'm not using margin if I don't have to. So I can roll this up to the 1050, basically collect the same amount of premium that I collected when I opened it for half a week. The danger is if this drops back down to $8 a share, because Bitcoin collapses or something. So my two choices there would have been just buy it back for $3 and leave it in cash or find something else to trade, or roll it up and collect more premium. But letting it sit there for another 3 days to collect $3 doesn't really make sense. When did I get this Tesla call? I can almost double my money on this one. Should I take a 70% return? I probably should, but then I won't be exposed to Tesla at all. I could have closed it for 12 at 9:30 this morning. What's this expiration date? June of 2026. Yeah, there's no rush for me to. I could technically. So this was a leaps. If I take profits. When did I buy it? If I take profits on 6.5 or later, then I get taxed at long-term cap gains instead of short. So I could take a page out of, if I ever do get to a point where I'm like, you know what, I do just want to lock in my profits, I can take a page out of Josh Mandel's book And instead of actually, so this is June 18th, instead of actually closing it before the long-term capital gains tax kicks in, I can just sell the very next strike next to it. So if I wanted to lock in, I mean, it would make more sense if, yeah, actually. So I could basically sell the 950 and I would be capturing, $1,100 worth of profit. And I would basically be turning this into a 950, 960 call credit spread. And then I just hold on to this until after 6.5, and then I can close this position for long-term capital gains. And this one, depending on what happens to the price, like if we went to $1,000 a share, this one would actually lose me money. So that might have a good effect on my taxes too. Because I'd sell it for $1,150, and if the price goes to like 1,000, I'd actually have to spend $5,000 to buy this back, which would be a $4,800 loss. So that's kind of interesting. So in 2026, I'd have a $5,000 loss. And this would turn into a $5,000 gain, but at long-term cap gains. So, okay, that's hurting my brain trying to think about how that works out with the taxes. But anyway, I just download the form and plug it into TurboTax and let that thing figure it out. All right, I think that's it for the day. I appreciate everybody tuning in. Let's take a look at the chats and make sure I'm caught up. Let's see, Rob. Wish I had time to dive into these MSTY positions. That spread looks like a long vol hedge. Their spread, you mean, or the one that I was demonstrating? Yeah, that spread looks like a long vol hedge. Yeah, I guess that's what they're doing, because they're it just seems like they're spending all of their short vol premium and just fucking YOLOing it into long. And I mean, at these prices, it does make some sense. I just don't like that much gamma risk on my long exposure. So I can't co-sign exactly what they're doing. I like it in spirit and in theory, but I just need more time to be right. I guess that's my conclusion on that one. All right, thanks everybody.